All right, so got a couple client questions here. So last time you were on the road, investors were particularly reluctant to accept the inflation acceleration idea. What was the reception?
It was definitely actually one of the sharper subscribers we have in California said this to me plainly at the end of the trip. We did Los Angeles, or first we did Los Angeles, San Diego, then San Francisco, so we saw a lot of people this week. And he came into the meeting early ahead of the guy who runs the place. And this guy's a very senior guy. He's been an analyst and now portfolio manager for about 20 years. And he said to me, he said, you know, when you first started making this call, Keith, you know, some of these themes over the years, you know, it really helped me. But that one I was like, nah, I think he's going to be really wrong on inflation accelerating. And I said, it's funny you say that because I thought it was pretty risky too. But and then he looked at me and goes, but this is on. This is on. And it's interesting to watch a buy-sider react to this because obviously with the foodstuff index up 14% year to date and components of that up 40 to 50, you know, you as a consumer analyst, and this guy's a consumer portfolio manager, you're not allowed to ignore this anymore. And again, it'll be interesting to see as the weather goes away, just watch these consumer prices continue to go higher. So I do think that this is the biggest call that we have if you look at it on the margin. No, it doesn't mean like you're kind of run-of-the-mill strategist that you just short the S&P 500. We're not short the S&P 500. We're shorting transports. We're shorting the financials. We're shorting consumer stocks. There's ways to play this. So again, it's a smart call, and we do think that you play it smartly. On the long side, obviously being long energy stocks, being long inflation, being long commodities themselves, being long foreign currencies. We got huge. This is actually one of the lower cash positions we've had right now, and that is primarily because I can buy everything other than U.S. growth stocks at their bubble highs.
Yep. And so you think the theme still has some legs here with people just coming around to accepting the idea?
Yeah, if people were long gold coming into the beginning of the year, gold wouldn't be up 12% for the year to date. I mean, people are going to have to chase this if it continues. And again, in chasing that, a lot of people I think will confuse kind of the headline news that the S&P 500 is hitting all-time highs as a reason to just buy anything. So I think the last 2 weeks, obviously, and specifically, have been confusing to some people because we've done basically a complete V. The S&P went from December 31st to where it was to down 6-7%, then completely straight up, and now kind of poking people on a number that we think is a lagging number. So again, it'll be interesting to see the game play through from here, as it was in 2011. If you bought stocks in the middle of March or early April 2011, good luck with that.
All right, and then. Second question here. So you debated Oaktree's Howard Marks the other night at your forecast dinner. Were there any notable points of agreement or disagreement that came up in there?
The biggest point of agreement was on the bubbliness of it all, but we picked two different markets. Like he picked toggle bonds, or picked preferred bonds or covenant light bonds. And he's like, look, this is actually redefining where we were, and that's not my market, so I didn't specifically know that, but I'll take his word for it. On my side, I was just basically explaining the confluence of events, which is again, you had these are all central planning bubbles. They're asset bubbles. You go housing bubble, gold and commodity bubble, food bubble. This is basically 2011, 2010, or 2011, 2012. Bond bubble, now equity bubble. We basically, Bernanke will have all bubbles, every single one, all-time highs on his watch. And that won't be for people to opine on with the 9 people in what used to be the Octobox on CNBC. This will be for our kids to look back on and say, wow, wasn't that a little bit of storytelling?
Yeah. All right, and then I guess just in the immediate term here, so we'll watch equities, but what else are you looking at kind of as we go through the morning here? Specifically, is it the 10-year? Is it the dollar?
Well, it's the dollar and the 10-year, but the 10-year bond yield is much more important than the dollar because the breakdown in the dollar below our tail risk line of 81.14 is so obvious right now that even a mucker can see it. On what I'll be staring at is the 10-year bond yield. I mean, we've been buying bonds, so I want to make sure that I'm buying more for the right reasons, which is the market telling me to buy bonds. If you break out above 2.8%, I mean, if you're the guy on this call who wants to just put pain on my book, what you should do is short the living daylights out of bonds at that level too, and we can have the game on situation, because that's really the line that matters to me. It's probably the most important line in my book.
All right, great. Thanks, Keith. Thanks, everyone, for dialing in. We'll see you back here Monday morning, 8:30.